There is an indicator that moves quietly. It does not trend on social media. It does not make dramatic headlines. It does not cause instant excitement. But when it shifts, markets change direction. Currencies adjust, stocks reprice, commodities react, capital flows move across borders, and most investors only notice after the move is already underway. The indicator I am talking about is real interest rates, not nominal rates, not the number you hear on the news, not the rate your bank advertises. Real interest rates. The difference between nominal rates and inflation. This one variable has quietly shaped nearly every major financial cycle in modern history. When real rates rise, liquidity tightens. When real rates fall, assets expand. When real rates turn negative, hard assets awaken. It is not dramatic, it is mechanical. Let us start simple. If the central bank sets interest rates at 5% and inflation is running at 2%, your real return is roughly 3%. That is a positive real yield. Capital feels rewarded for staying in bonds. Cash feels relatively safe. Speculation becomes less necessary. Now imagine interest rates are 5%, but inflation is running at 6%. Your real return is negative 1%. You are losing purchasing power even while earning interest. That changes behavior, and behavior changes markets. When real rates are positive and rising, capital becomes conservative. When real rates are negative and falling, capital searches for protection. That is when gold moves. That is when silver begins to stir. That is when speculative assets suddenly look attractive. Not because people are greedy, because they are defending purchasing power. Let me give you a historical example. In the 1970s, inflation surged. Nominal rates struggled to keep pace. Real rates turned deeply negative. The result, gold exploded higher. Silver followed. Hard assets became a refuge. Then in the early 1980s, real rates turned sharply positive under tight monetary policy. Inflation collapsed. Commodities reversed. Asset cycles shifted for decades. The indicator moved. Everything followed. Most investors focus on stories. They focus on narratives. They focus on headlines. But markets respond to incentives. Real rates change incentive. If your savings are losing value in real terms, you move. If your savings are gaining value in real terms, you stay. It is that simple. Now let us bring this forward to today. We are in a world of massive debt, government debt, corporate debt, consumer debt. High debt changes how central banks behave, because if rates rise too far in real terms, debt becomes difficult to service. Growth slows. Markets tighten, pressure builds. So policymakers walk a narrow path. They try to fight inflation without breaking the system. That tension is visible in real rates. When inflation expectations rise faster than nominal rates, real rates fall. That is when markets begin pricing in asset inflation. When nominal rates rise faster than inflation expectations, real rates rise. That is when risk assets struggle. You do not need to predict headlines. You need to monitor this relationship. Let me explain why silver specifically responds strongly to this indicator. Silver is both an industrial metal and a monetary metal. It sits in between growth and protection. When real rates fall and liquidity increases, growth expectations improve. Industrial demand strengthens. At the same time, investors look for inflation protection. Silver benefits from both forces, but when real rates rise sharply, liquidity tightens. Industrial demand expectations soften. Inflation protection demand fades, silver cools. Again, not emotional, mechanical. Now here is where many investors misunderstand cycles. They assume markets move because of good or bad news. In reality, markets move because the cost of capital changes. Real interest rates are the cost of capital in real terms. When capital becomes cheap in real terms, assets inflate. When capital becomes expensive in real terms, assets deflate. Let us look at equities. When real rates are low or negative, future earnings are discounted less harshly. Growth stocks appear more valuable. Risk appetite increases. When real rates rise, future earnings are discounted more heavily. Valuations compress. Multiples contract. You may hear analysts talk about valuation adjustments. But beneath the surface, real rates are often driving the repricing. The same applies to housing. Low real rates make mortgages effectively cheaper in purchasing power terms. Demand increases, prices rise. High real rates slow housing activity, affordability declines. Cycles turn. If you only watch headlines, you react. If you watch real rates, you anticipate. Now, how do you monitor this indicator practically? You look at treasury yields. You look at inflation expectations, often measured by break-even inflation rates. Subtract one from the other. That is your real yield. You do not need advanced mathematics. You need awareness. When 10-year real yields begin rising sharply, liquidity conditions are tightening. When they fall, liquidity is easing. Everything else tends to follow with a lag. Currencies adjust next. A country offering high real yields attracts capital. Its currency strengthens. A country offering negative real yields sees capital outflows. Its currency weakens. This is not ideology, it is arithmetic. If investors can earn a real return in one currency and lose purchasing power in another, money flows accordingly. Now consider the dollar. The dollar is not strong or weak in isolation. It is strong or weak relative to real returns. When United States real yields rise relative to other nations, the dollar strengthens. When they fall relative to others, the dollar softens. And when the dollar moves, commodities respond. Because commodities are priced globally. A stronger dollar tends to pressure commodity prices. A weaker dollar tends to support them. Again, the chain reaction begins with real yields. Indicator moves. Everything follows. Let us pause for a moment and think long term. We are entering a decade defined by three forces: high structural debt, demographic shifts, energy transition, and industrial demand expansion. These forces increase fiscal spending. They increase deficits. They increase pressure on monetary policy. It becomes difficult to sustain high positive real rates for extended periods in such an environment, because the debt burden becomes restrictive. If real rates remain high, refinancing costs surge. If refinancing costs surge, fiscal strain intensifies. Eventually, policy must adjust. And when policy adjusts, real rates change. When that happens, markets reposition quickly. You do not need to guess when the shift will occur. You need to recognize it when it begins. This is not about panic. It is about positioning. Most investors chase price. Disciplined investors monitor conditions. Real rates are a condition. Prices are a reaction. Now let us consider a psychological layer. When real rates turn negative, savers feel punished. They may not articulate it this way, but they feel it. Bank balances grow numerically while purchasing power shrinks. That subtle pressure drives behavior. Investors seek alternatives. Some choose equities. Some choose real estate. Some choose gold or silver. Some choose speculation. But the root cause is the same. The real return is negative. When real rates are strongly positive, patience is rewarded. Risk-taking declines. Speculation cools. Excess fades. You can see this in market tone. Negative real rate environments often coincide with euphoria. Positive real rate environments often coincide with discipline. Not always immediately, but consistently over cycles. Now here is the key question: where are real rates heading? Are they structurally rising? Are they peaking? Are they about to reverse? That is the conversation that matters. Not daily volatility, not weekly headlines, direction of real yields. Because when they pivot, markets pivot. Let us move deeper. Real interest rates do not operate in isolation. They interact with liquidity, credit creation, and fiscal policy. When governments run large deficits, they must issue debt. Issuing debt increases supply of bonds. If demand for those bonds is weak, yields rise. If inflation remains elevated, real yields may still remain negative. But if inflation falls faster than nominal yields, real yields rise. This dynamic often surprises markets. For example, imagine inflation begins cooling rapidly. Nominal yields remain elevated because the central bank is cautious. Suddenly, real yields rise sharply. Liquidity tightens even though inflation appears under control. Risk assets struggle. This has happened before. Markets celebrate falling inflation without noticing rising real rates. Then volatility increases. Because the indicator moved, everything followed. Inflation expectations begin rising due to fiscal stimulus or commodity shocks. Nominal rates lag behind. Real yields decline. Liquidity expands in real terms. Hard assets begin moving first. Equities follow. Speculative pockets ignite. Observers blame greed. But the cause is monetary. Negative real returns push capital outward. Let us bring this to silver again. Silver's supply growth is relatively constrained compared to fiat currency expansion. When real yields fall and liquidity expands, the relative scarcity of tangible assets becomes attractive. Industrial demand provides an additional layer. Energy transition technologies use silver. Electronics use silver. Solar uses silver. If monetary pressure aligns with industrial demand growth, silver's response can be amplified. But it begins with real rates. Now imagine a scenario where real yields begin declining after a tightening cycle. The first phase is skepticism. Investors assume it is temporary. The second phase is confirmation. Yields continue declining. Liquidity slowly returns. The third phase is momentum. Capital reallocates aggressively. If you wait for headlines in the third phase, you are late. If you monitor real rates in the first phase, you are early. This is the difference between reacting and preparing. Let us discuss timing carefully. No indicator provides perfect timing. Real rates can move gradually. Markets can anticipate changes. But direction matters more than precision. If real yields have peaked and begin trending downward over several months, that shift carries weight. If they continue rising persistently, caution is warranted. Disciplined investors focus on trend, not noise. Now consider the broader macro environment. Demographics in developed economies are aging. Productivity growth is uneven. Debt levels are elevated. These structural factors often favor lower real rate environments over time, because sustaining high real rates in a high debt environment becomes politically and economically difficult. This does not mean rates cannot rise temporarily. They can. But structurally, there are limits. If real rates are pushed too high for too long, financial stress emerges. Credit spreads widen, growth slows, policy reverses. The cycle turns. When the cycle turns, asset allocation shifts. Hard assets may outperform, equities may recover, currencies may adjust, indicator moves. Everything follows. Let me give you a practical framework. Ask 3 questions regularly. 1. Are real yields rising or falling over the past 6 months? 2. Are inflation expectations accelerating or decelerating? 3. Is fiscal policy expansionary or restrictive? The interaction of these answers shapes capital flows. If real yields are falling, inflation expectations are stable or rising, and fiscal policy is expansionary, liquidity conditions favor tangible assets. If real yields are rising, inflation expectations are falling, and fiscal policy is tightening, liquidity conditions favor caution. It is not about emotion. It is about incentives. Now let us address risk. Understanding the indicator does not eliminate volatility. Silver can decline even in favorable real rate environments. Equities can rally even when real rates rise. Short-term moves are complex, but long-term cycles respect monetary conditions. That is the edge. Now let us address something important. Many investors look for certainty. Markets do not offer certainty. They offer probabilities. Real interest rates shift probabilities. When real rates decline, probability of asset inflation increases. When real rates rise, probability of asset contraction increases. That is all you need to know. You do not need dramatic predictions. You need structural awareness. Let us imagine 2 investors. Investor A watches headlines. Investor B watches real yields. Inflation begins cooling. Headlines celebrate. Investor A increases equity exposure aggressively. Investor B notices real yields are rising because nominal rates remain high. Investor B reduces risk. Months later, markets correct. Investor A reacts emotionally. Investor B adjusts calmly. The difference was not intelligence, it was focus. The indicator moved. Everything followed. Now let us step back and ask a deeper question. Why does this matter for the next decade? Because we are in a transitional period. Globalization is shifting. Energy systems are evolving. Debt burdens are high. Monetary regimes are under pressure. In such environments, small changes in real rates can trigger large capital reallocations. If policymakers choose to suppress real rates to manage debt, hard assets may benefit. If policymakers defend positive real yields to stabilize currency, growth assets may struggle. Watching this balance is essential. You do not need to predict speeches. You need to observe data. Real yields reflect policy credibility. When they decline sharply due to inflation rising faster than nominal rates, credibility is questioned. When they rise sharply due to tightening faster than inflation, growth risk increases. Both outcomes carry consequences. Markets price those consequences. Finally, let us speak about discipline. You cannot control central banks. You cannot control inflation. You cannot control fiscal decisions. But you can control how you respond. Monitoring real interest rates gives you a framework. It prevents emotional reactions. It encourages structured thinking. It aligns you with incentives rather than narratives. The most powerful investors in history did not chase stories. They studied systems. Real interest rates are part of the system. They are not exciting, they are not dramatic, but they are foundational. When they move meaningfully, capital repositions. Currencies adjust. Assets reprice. Volatility increases or decreases. Indicator moves. Everything follows. If you remember only one thing, remember this: price is the surface. Incentive is the cause. Real interest rates shape incentive. Watch the cause, not just the surface. Because by the time price confirms the shift, the opportunity is often already gone. Disciplined investing is not about predicting the future. It is about understanding the forces shaping it. And when this indicator moves, it rarely moves alone.